Picture this, it's 1973, the stock market just crashed, and Seth Klarman strolls through his small Boston office with a quiet confidence. While Wall Street bulls panic, Klarman hunts for hidden gems trading at frightening discounts. But there's a secret no one talks about, a safety cushion that keeps investors sane and rich in chaos. What exactly is this invisible margin that turns risk into opportunity? Stick around, because unlocking it changes everything. Most investors leap at flashy trends, dazzled by overnight millionaires. But Klarman reveals why chasing fads is a losing game, a trap set to burn your money faster than you can blink. In the late 1980s, Klarman watched countless investors jump on the junk bond craze. Names like Drexel Burnham lit up the headlines, promising explosive returns. But many who bought in blindly faced brutal losses when the bubble popped, revealing that hype often masquerades as profit, ready to vanish overnight. Imagine investing like playing poker at a casino versus buying a piece of a solid business. Speculation is betting on luck, thrilling but reckless. Value investing, on the other hand, is like buying a sturdy house for less than it's worth. You're not gambling, you're negotiating a deal with risk on your side. The real magic? Waiting. Klarman's approach flips the script: buy undervalued securities and hold on through the noise. This patience isn't passivity, it's a calculated defense. Over time, it compels the market to recognize the true value, turning patience into steady, outsized gains. Klarman leans heavily on Benjamin Graham's mantra, margin of safety. But what does it really mean? Let's unwrap this invisible shield that guards your capital when markets spiral. Klarman recalls a 1987 deal on a biotech company trading at half of its estimated liquidation value. Despite negative headlines, he bought with a huge margin of safety, enough to absorb storms without losing sleep. When others panicked, his stake soared, proving that discounts aren't just numbers, they're built-in armor. Think of margin of safety like a safety net under a tightrope walker. The market's pessimism acts as that net, pushing prices down unjustly. By embracing this fear, investors earn not just protection but also a higher reward, because they bought assets others irrationally undervalued. The surprising edge: most investors run from fear, but Klarman shows that leaning into it transforms volatility from enemy to ally. The market's wild moods create openings to buy bargain stocks, giving you a leg up over reckless speculators chasing the thrill. Klarman's secret sauce isn't just buying cheap, it's sticking to a disciplined plan when everyone else goes haywire. Here, why discipline is your best bet in wild markets. He recounts a moment during the tech bubble slowdown in the early 90s when everyone was chasing dot-com stocks. Klarman stayed cold, deciding not to invest mere hype without solid backing. This restraint preserved capital and positioned him to buy strong companies dirt cheap when the bubble burst. Klarman treats investing like detective work, carefully sleuthing company fundamentals, financial health, and management quality. It's not flashy, but it uncovers nuggets hidden under layers of market noise and hype, equipping you to buy real value rather than chasing illusions. The data confirms it. Investors who patiently apply discipline outperform knee-jerk traders. Klarman's blueprint shows that regular, rational decisions, with a margin of safety as guardrail, produce a portfolio that grows steadily without the roller coaster heart attacks that speculation guarantees. Remember that 1973 crash office? Klarman's secret was never betting on the crowd's frenzy but on his margin of safety, a buffer that turns panic into profit. Next time you're tempted to chase hot stocks, pause, ask yourself, am I buying value or gambling? Try this. Look for bargains trading well below their true worth. Your portfolio will thank you. Subscribe for more book summaries like this one.